In fact, we have with us K. Ravi Kumar, the former CMD at BHEL, and Mr. M.S. Unnikrishnan, MD and CEO at Thermax, currently joining in on the show. Gentlemen, morning. Mr. Ravi Kumar, if I could start off the discussion with you. You know, like my colleague just rightly highlighted, it has indeed been a very prolonged phase of slowdown within the capital goods sector. But we're finally seeing some yellow weeds actually emerge. You are seeing order flows kick in, but very concentrated and within, small pockets thereof. But yes, there has been a recovery in the short cycle. How would you say the landscape is gearing itself for 2019?
First of all, a very happy New Year 2019. I think it should bring a lot of cheer to the capital goods industry. We have seen softening of crude prices, that's number one. And there are a lot of CAD is going to come down. You know, crude is at $51 per barrel. So it is going to come down. CAD is going to come down. And there is a lot of OMOs being resorted by Reserve Bank. So cash flow is also expected to be better. And there are about 7-8 favorable factors, tailwinds to the capital goods sector. So I feel capital goods sector is expected to do well definitely in 2019, and it will be a year where long period of slowdown has really been, it will be pushed back to good years. See, the problem with solar energy is that it is available only between 10 o'clock to 4 o'clock or 5 o'clock. But there is a limit at which solar can be used. So there will be a demand for coal-based power plants once there is a pickup in demand for electricity, which will come from 7.2 to 7.5% growth in GDP, and also in there is a definite consumer spending is also there. So 24/7 power also is being promised by the government, and this being an election year, definitely there is going to be a huge order inflow which is going to take place from April of next year. So up to January, March there may be a slight slowdown, but after April there is going to be a pickup in capital goods industry as far as power is concerned. There is also all the railways are going to be electrified. There is a push for electric infrastructure for vehicles, which is on environmental concerns. So that also will give a good pickup for electricity. The third thing is there is environmental concerns which are there. So there is a huge limit being put on the thermal power plants and also on refineries. So that is going to be a big push for the electricity demand. So in all that, solar and wind of course is only for 5 months or 4.5 months. So definitely there is going to be a base load is necessary for thermal. So I think CA has already identified a lot of places where thermal plants have to be put based on coal. And there is a huge program, at least 1,000 million tons of coal being done by Coal India in next 3 to 4 years, and also the bottlenecks for coal movement is also being done by the government. So there is going to be a definite push for coal-based power plants in the near future. So that should give a lot of push to Thermax, BHEL and L&T and all these companies who have put up new plants. So this is a temporary phase where 2 years they have managed. Still they got orders, during these tough years. So I think the year ahead will be really good. So, and also smart cities, there is going to be a big boost, and railways are electrifying. That is a good this one, and also there is lot of for solar and the wind power to be evacuated. There is a separate grid which is required actually. So that will throw up lot of opportunities for T&D, transmission and distribution. And the losses, there is a cap under the Uday scheme to limit the transmission and distribution losses, that is commercial losses, smart metering, and also the transmission distribution network, high technology upgradation in T&D area. These are all we are expecting in the next few years. But companies should adopt to good research and development, so that these things can be accomplished.
Mr. Ravi Kumar, Mr. Ravi Kumar, I'm just going to come back to you. I just want to quickly bring Mr. Unnikrishnan as well in on the discussion. And Mr. Unikrishnan, we have seen some improvement in investment sentiment. There has been a pickup in short cycle orders from the public. How has this helped the growth in the sector so far, you think?
Those who are into equipment manufacturing and sales in the capital goods and engineering sector are reporting very good results. However, those who are dependent upon the larger projects, infra projects and government funded projects are not seeing the uptick happening beyond the level. So the private capex, which is of the limited nature and mid-size kind of projects in maybe 20 and odd different sectors like textiles, food processing, alcohol, beverages, light engineering, pharma, auto ancillaries, tire cord manufacturing, carbon black, all the sectors are investing, and those who are dependent upon these sectors are doing quite well at this type of point of time in terms of growth as well as order intake. However, those who are dependent upon the road projects, those who are dependent upon the very large oil and gas, refinery, plastic industry, heavy chemicals, steel and cement are yet to be seeing light of the day in terms of the growth story happening for it.
Right. But Mr. Unikrishnan, large orders have been concentrated in only select sectors. What is the sense that you are getting about the outlook for order inflows for your company as well as the overall sector too?
See, the larger sectors that do contribute to the project orders for companies like Thermax, starting with power, I need to say it's a wash off, and there is nothing is going to be happening for some more time to happen. However, there had been selective ordering which had happened in the last 1 year period of time in the steel industry by two large companies. One order came to our organization, another one went to another larger company in the country. We've seen fertilizer industry going ahead with captive power ordering and also expansion for two specific locations. And I think it is going to be continuing in that sector. Oil and gas had been a real disappointment in the last year, though they have gone ahead with the ordering for the Bharat 6 related refinery upgradation. We have not seen as many orders happening for the fresh capacity expansion for the refinery, which is anticipated to happen in the last year. With an election year ahead, I don't think any ordering is going to happen for one more year in the oil and gas sector. Then coming to cement sector, there had been fairly good traction happening for the green energy, which is a waste heat being converted into self-generation of power. That had been going at a very fast pace last year, and I'm expecting it to be continuing for the next 1 year. Brownfield expansion had been limited to only 1 or 2, so I'm expecting a lot more of greenfield and brownfield capacity expansion program in cement industry in the next 18-month period of time. So these are the major industries which we can talk about in terms of forward ordering for larger projects.
Right. Mr. Ravi Kumar, in extension to the points that you were earlier making, while smaller size capex has indeed begun to come on stream, and you also talked about as to how railways has also, really seen a big construction spree kicking in, but large ticket private sector investments are still not happening. When do you think we can see a meaningful pickup or a revival come into large ticket investments?
Yeah, as far as private sector is concerned, there are a lot of stranded projects. So, but the IBC has come, so we hope all these projects will come on stream. Then only it is possible for new capacity to come from private sector. Private sector is not going to invest much. The orders are going to come from NTPC and state electricity boards in the next 1 year. After that, only private sector we can expect, because there are a lot of stranded projects, and unless all those issues are resolved, and also coal linkage has been assured, it is going to be a little problem. But one silver lining is the IEX price, exchange price has gone up for electricity. That should put a lot of private sector to come in. Definitely big players like Adani or some big players may come in again after a year. But as of today, I am not expecting private sector investment for the next 1 year, because there are a lot of stranded projects, and also the PLF of thermal stations is hardly 61%. So the orders will come from NTPC and state utilities basically, and there is also a problem of grid. So there will be huge investment coming in T&D. And the REC, PFC, if the merger takes place also, then there will be huge capital being infused in the power sector. So I feel to reduce the T&D losses and also for new generation, it will be mostly from government sector, and the private sector will come in only in 2020.
Right. Mr. Unikrishnan, the direction of crude oil prices, I guess, would also be a major risk for your sector. With the acute volatility, how is it that you see the sector dealing with this issue?
In fact, I would say that even $50–55 for a barrel is an investment grade in terms of oil and gas sector and plastic sector. India, in any case, do not have to look at what is the crude oil price because it's an imported item for India. We need to look at the automobile production, which is rising up. Though people may be complaining that in the last 1 or 2 months there had been a reduction in auto sales, but per se the quantum of new automobiles coming on the road being so high, we need to increase our refining capacity. And I am hopeful that even at $50, $55, even $40 and above, oil and gas makes a lot of sense in terms of capacity expansion for a capacity constrained country like India. And the global market also, despite the prices having come down by 70% in the last maybe 6 to 7 month period, we still see inquiries prevailing for capacity expansion.
Kumar, as we wind down on this discussion, also want to understand, you think issues of high interest rates, land acquisition issues, and a huge, state of stuck and stranded, unoperational projects is now behind us? Or would you think these will also continue to be niggling worries into the next year too?
There is definitely an improvement as far as the land acquisition is concerned, because CEA has identified some land for future thermal projects. So I feel that land acquisition issue, it has been being addressed by the government. But high interest rates, there is not much improvement, but still it is static at least to that extent. And working capital, there is definitely a lot of capital is now being pumped in, liquidity is being pumped in. I think the RBI also should do a little so to push more money into the system. So with all these things put together, I think there will be a pickup definitely in the second half of 2019, and 2020 will be a year for capital goods as far as power is concerned.
Okay, Mr. Ravi Kumar, Mr. Unikrishnan, thank you both of you for taking the time out and joining in, and hopefully it's a happy 2019, not just for the capital goods sector, but for all of us as well. Here's wishing you from all of us here at ET Now.
Thank you.
Okay, let's take a very quick break on that note with news that we are pretty much status quo actually from where we started off, haven't moved much. In fact, if nothing, we're scaling at the highest point in the day. It's a good 1% move that you're seeing. So 10,900 is where the index is right now. Let's see whether we manage to sustain these levels as we wind down 2019. Still a day left to go before we close in for 2018. Sun Pharma, UPL, Titan, Yes Bank, IndusInd, Z for a second consecutive day, and HDFC are the ones which are powering the index ahead. It's a very strong breath as well. So you've got NBCC holding up 4.25%. PC Jewelers is looking very smart. There's R Power, there's Karnataka Bank, GSFC, all are names which are extremely buoyant.